let's get in some sense of what may have triggered this. Mayuresh Joshi joins in. Mayuresh, we're talking 100-point nosedive on the frontline index in a matter of minutes. What do you think is going on?
Morning, Avan. So clearly, I think we have been reiterating our points related to earnings being extremely weak for this quarter and at least for the next quarters to come. So clearly, I think earnings downgrades is something that we're probably looking at. Again, I think there is no major respite probably happening on the capex cycle, and the international cues are not supportive at all. So if you look at the Japanese data that's come through, you're not really sure of what kind of Chinese data will be thrown up over the next few weeks and months. And clearly that's going to have a huge impact. With the fall in crude, you're probably looking at tapering off of global demand. So all these factors are probably playing out on the markets. And one really is not sure, even on the budget aspect, on what kind of reform processes and measures will actually come through. So clearly I think you're seeing some amount of pain still left in the markets, earnings not reviving, the capex cycle not reviving, and that clearly is playing on the stock prices.
Shinoy is also right here with us of Capital Mind. Deepak, morning, and what a nosedive we've absolutely taken right now, despite the fact that the Asian peers at least are holding on for now. What do you think has spooked the markets in the last couple of minutes? Would you have a handle on that? Deepak, that's for you.
Hello. Yeah,
Yes,
I'm sorry,
Deepak.
I didn't hear the question. Could you repeat that?
I was just asking that what do you think has spooked the markets in the last couple of minutes? Because as far as the rest of Asian markets go, you've got the Japanese markets as well as the Hang Seng at least holding on pretty steadily for now.
Yes, I think today seems to be an irrationally low liquidity day. So even a small amount of selling seems to be causing a little bit of panic in many of these counters. So I would advise going with the caution on this move, because there is very little liquidity left to sell. In the sense, there's not many buyers. Apparently, there is definitely more damage in the mid caps and the small caps than the large caps. So even selling has to be proceeded with caution. This looks like extremely low liquidity.
Yeah, and really unexpected, Deepak. But I just want to, highlight what Mayuresh just flagged off. Yes, there are concerns when it comes to weak earnings, the fall in crude prices, subdued China data. But do you think budget uncertainties would be a big factor as well that may be playing on the minds of the market?
I think this is a little too early to speak of the budget uncertainties. I think today seems to be something else. The problem with markets typically is you don't really know the reason when things happen. It typically comes out afterwards. So we're hoping that this might be, this might hopefully not be backed by something really sinister, and this might be just a temporary fall. But this is unfortunately one of those times where we can't explain why exactly this has happened. I think it's a little too early to call it something that's related to budget uncertainties. Results haven't come in as yet, so this low volume selling might only be because some investors that want to sell, the buyers simply aren't there in the market. Everybody's perhaps waiting for results or something to happen in order to push up more buying. It might just be that turning point for the market after a long spate of selling.
In fact, take a look at what's nosedived as well in terms of the metal names. 1.5% gone on the metals index, and Vedanta has lost close to 4%, and Jindal SAW is also down at just that 56.40 mark. Mayuresh, the start to the earnings season also hasn't really been the best. The commentary from the management wasn't too encouraging in terms of what TCS was talking about. What's the sense you're getting that for the rest of the earnings season over the next month and a half, we will see further pressure build up because of the earnings cycle as well?
Yes, clearly, and the markets, if they have to react very positively, need to act on a re-rating of earnings which are not expected to come through. And let's have a very broad-based picture or a perspective on this whole thing. Clearly, you're looking at IT being extremely soft in this quarter and the next. You're probably looking at the banking stocks, a lot of cleaning up happening specifically on the PSU part. You're going to see some amount of asset quality pressures come on the private side, with the exposure that certain banks have on metals, infra, real estate. You're probably going to look at capital goods being a lot weaker in this quarter as well, with execution issues probably still persisting on balance sheets. And a stock-specific approach when it comes to pharma, because their valuations in terms of historical comparisons are on the higher side. So what really leaves out of the Nifty earnings are very, very few stocks. So you're probably not going to see earnings probably come through. And that, again, is a big big kind of a softness that the markets is probably looking at. And clearly, I think there are trigger points that are probably missing into these markets as well. So clearly, I think you're probably looking at the softness in markets to continue, and probably we need to wait for triggers, which in fact might come out for the budget if some positive announcements are made. But till that point of time, we're probably getting probably stuck to the direction that the international markets will point out at.
CK Narayan also joins in, and it's not comforting at all, Dr. Narayan, to see these levels and a rapid fall. What are you advising on the Nifty right now, and are there any indications on the Nifty that this kind of an undertone or undercurrent is here to stay even for the medium to long haul?
I think everybody has been taken a bit by surprise at the pace of the decline. It was very, very fast and furious, and came completely out of the blue, and nobody seems to have a clue as to why this has happened. But as traders, it's not our question to ask why it has happened, address the fact that it is happening. First up, I think whatever intraday long positions had been made have either got stopped out or need to be forcibly removed on any small rally that you get into the first levels of resistance. Second, the Nifty still seems to be defending the area around 7,500 on the futures, but then there has been today with the futures making 74.70. I think bullish views should be shelved for now until there is some clarity of the situation. I do we can raise the lows that we saw around 74.70 and go down to about 74.50 levels. So going from here till about the later part of the day towards the end of the session, I think we should be looking for the markets to fall down to about 74.35 to 74.50 on the Nifty futures. So long positions out, and on any intraday rally, intraday traders can attempt a short position for the day.
There's another close to 50 to 65 odd points of a downside that Dr. Narayan seeing. Dr. Narayan, we've got, banks in an absolute sell-off mode. Names like an Axis, PNB, IDFC, they're all at fresh 52-week lows, ICICI as well. What would be the strategy on the Bank Nifty as well from these levels?
I think Bank Nifty remains a sell. 15,800 was the first of the hurdles which had to be. It seemed like doing it in the morning. Now it's decisively broken. I think at these levels of about 15,700, I would suggest shorting the Bank Nifty as well. I think Bank Nifty is a better sell compared to the Nifty because all the banking components, whether they are private sector or public sector, they're all under pressure and they should probably drag the Bank Nifty down further. My sense is that we should be seeing 15,500 or thereabouts very soon up on the board by before the end of the day.
Okay, just a quick status check as to what's going on right now. 75.01 on the index, down 2.7%. We've recovered, but I don't think that's going to be a very comforting factor given the rapid or fast and furious pace at which we've fallen, as Dr. Narayan aptly put it. 52-week lows as Mega flagged up for a number of those banking names. They're all in the red. Adani Ports, JK Cement, PFC, Jubilant Foodworks, even heavyweights like Reddy's and TCS are currently in the red as well. Mayuresh, what is your advice on how one should be approaching the banking space? Yes, no doubt, we have braced ourselves for a fairly okay earnings season, but are there worries that things might turn out to be way worse and even continue like this for some more time?
So clearly, as I mentioned earlier, the softness in the asset quality will continue at least for this quarter and the next. And clearly, the RBI directive that possibly come through will ensure that the banks clean up their balance sheets in a more sustainable fashion over the next few quarters. Having said that, probably in terms of our earnings outlook over FY17, we still believe that the larger private sector banks, considering their branch network, considering their capital adequacy, should be far better placed to their public sector counterparts. And though valuations are a little bit on the higher side, our take is that you should buy a bunch of these private sector banks rather than concentrate on a single stock. So clearly you're probably looking at earnings being a little bit soft. But again, I think the earnings recovery over the next few quarters should be equally sharp if one really assumes the rate cuts emanating into faster credit growth. Credit costs are assumed to be a little bit high over the next few quarters. And clearly, I think the valuations, if the banks do decline further from the current levels, would be extremely supportive for their earnings trajectory. So clearly, I think a clutch of these large private sector banks is what we'll be looking at. But again, I think one really needs to invest in a very staggered manner over the next few weeks so that it reduces your impact cost and it also de-risks your risk profile when it comes to investing in a particular sector.
Very pertinent advice. One needs to pace out the investments that one takes also at at a juncture like this. Deepak, we've got an absolute sell-off coming in. All our experts right now, are agreeing that we probably see more pressure in the coming few weeks. But if one has to cherry pick and pick out good quality names, good quality sectors, what really would you be comfortable at least staggering your investments in at this point?
My feeling is two things. Firstly, one for the short term, when I'm part of the bearish crowd, if you may. But if most of the crowd turns bearish, that's probably the best time to buy the market. But in general, we looked at certain areas that are showing some signs of at least positive growth. We're seeing textiles, where despite all the carnage happening, the lower input costs and the higher dollar, the stronger dollar seems to be something that will benefit these stocks. They're not very high in terms of PE. And also we're looking at pharma, which has been beaten down, but we believe that in the longer term that they will continue to dominate, because one of those sectors which will almost never die unless you have a event of a fairly large magnitude. So I would expect pharma to outperform in the next few years. So those are some sectors we're really looking at. But at this point, I would be circumspect. I believe that markets continue to be, they'll be violently volatile, and we're seeing low volumes day like this. You can't even get out when you want. So I'd advise a lot of caution and lower position sizes.
Okay. Let's also get in Ajay. He joins in from our research team. And Ajay, this kind of a fall has been very unprecedented, taken everyone by surprise. But you've been working the phones, talking to some of the dealing rooms. What are you picking up?
Well, Avan, it was kind of actually expected. Some of the participants in the market were expecting this to happen, because up till now, last 4-5 days have only been punishing for the large cap basket. In fact, yesterday, when the market fell, at a time when rest of the world was rallying, there was a readjustment on yuan on the higher side, which triggered a rally in global markets. But India did not participate in that rally. We underperformed massively the Asian peers and globally. Today also, if you see, Dow futures are indicating a 140-point gain. Rest of the world is in much better shape, but we could not survive, being in the green even for an hour or so. Mid cap and small cap area collapsed a whole lot. So the dealing room guys are saying that it's the HNI community and some of the treasuries and family office. So chunky money, which was massively parked or hiding in mid caps, which was having a big party last couple of weeks, is the one which is liquidating now. So large caps may actually trade range bound or with minor cuts, but watch out for some of the mid cap names where capitulation seem to have started, liquidation has started, because there are still 4-5 baggers for people who got at lower levels. Even now, if they go ahead and liquidate, they are still on money. So mid cap is the area to watch out for, because the area was got very frothy, and dealing room guys are indicating that margin calls are getting triggered, HNIs are liquidating positions. So this could be a new pain area or pain point for the market in the near term.
Really seems to be the case, Ajay. In fact, if you take a look at the big names that have suddenly rather the names from the broader markets that have suddenly collapsed, you have the likes of a Himmat Singh, that's down 10%, Sonata Software, PSL, HFCL, that's seen a cut of about 8% Mercator, like Ajay pointed out, it's clearly the broader end of the market that's seeing the most pain rather than just the frontline names. Mitesh, give us a sense on some of these, these small cap to mid cap sort of names as well, which are seeing these sharp cuts. What would be your strategy for this space?
See, I think, very clearly, this is also a space which is possibly going into correction. JSW Energy, for example, I think, has given a big breakdown in the last few minutes. I think possibly resuming its downtrend should retest the lows of around 71 over here. So there could be a 10% cut happening for the stock. My sense is broadly is that I think, breaking 7,500 when we were seeing some kind of support zone emerging, and I think if we continue to sustain below 7,400, then I think next few days could still push you more down, and that could mean corrections not only happening in the large cap stocks, but mid cap stocks which were outperforming, stocks like ADG Group which were outperforming and then were extremely overbought on the intraday to short term charts. I think they'll go through a slightly deeper kind of pullback.
Okay, that's a call on how to approach the broader end of the markets. Yes, banks the worst hit, but IT is not spared at all. TCS, of course, one of the big laggards. And Dr. Narayan, earlier this morning, you advised a short selling recommendation, which has worked out very well at 22.63. What's the call on TCS?
I think we should continue to remain short. The stock is only indicating and reaffirming its intent to decline further. I would say any rally that you get on an intraday basis, whether to 22.80, 85, I think would present us with further shorting opportunities. I do believe firmly that we should be seeing sub 2200 levels on this name very shortly.
Okay, 64 rupees gone already, and another 60 rupees could easily go as well, as per Dr. Narayan. Mayuresh, would you also come in on, how TCS has been? We've been discussing this heavyweight all morning. But besides TCS, what is the opinion coming in on the rest of the IT pack as well? Because we've got, just about everything here also tumbling a fair bit. Hexaware, KPIT Tech, Just Dial, they're all seeing a big knock.
Clearly, I think the next two quarters, the quarters that we're probably going through right now and quarter four are going to be weak quarters, and that's been known to the markets. Clearly, I think what happened with Chennai is going to have some amount of headwinds for a few companies in terms of how the volume growth or the volume degrowth basically comes through. But clearly, I think if you look at constant currency terms, I think you're probably seeing some amount of pain still there in the system. You're also probably looking at client budgets getting firmed up in this quarter itself. So clearly, I think the energy verticals, the insurance verticals, the retail verticals, for a lot of the top-tier IT companies, I think the client budget spending there would be keenly watched out for, as well as the management commentaries surrounding the entire IT environment for the year to come. So clearly, I think the larger cap IT is somewhere where we believe that the valuations after the correction that we witnessed are seeming very, very positive. But clearly, I think one needs to understand the management commentaries in greater detail before one really takes a call in terms of how earnings are expected to pan out for a lot of these.
Okay, just keep an eye out on the markets right now. I mean, as if we haven't been doing that already. But Deepak, I wanted to talk about something a little more broad, because every day when we're interacting with market experts, we seem to be getting a sense that compared to the other emerging markets, the way our GDP growth is, things are looking fairly good. There is likely to be stabilization when it comes to the overall macroeconomic picture. Are you really buying that side of the argument? And, should one at least not worry when it comes to that factor?
Well, I actually am on the complete other side of that argument. I believe that we are the situation in much of the macro data is actually quite dismal. I mean, the IIP numbers you should ignore because of the Diwali effect. We've still calculated October plus November averaged. We're talking a 3.2% growth in IIP, which is not all that great for a country that's been in the manufacturing doldrums, if you may. And then we're seeing a massive drop in exports. We're seeing GDP numbers which, not necessarily believable, because we're talking 7.5% in real terms, but in nominal terms, this GDP growth is actually 6%, which is the lowest in a very, very long time, and attribute that to disinflation, if you may. But so overall, the macro data does not look good for India as an individual country, but relatively, yes, perhaps to Brazil and Russia, we're definitely doing better. But that still doesn't prompt the kind of valuations we're getting right now. We're getting a 23 PE on the CNX 500 despite this fall. And I believe that's in the upper 5% of the PE range that the CNX 500 has been in the last 8 years. I think just a correction down to the 18 levels would make it a 20% fall from here. And we believe earnings will be, stressed even in the December quarter. So I don't see this as a fundamentally great reason to buy India at these valuations right now, even though it's relatively better than other countries.
You've got absolute unwinding coming through in the cement space as well. Mitesh, if you've had a look at some of the cement names as well, especially in the in the mid-cap to the small-cap segment, the likes of a Deccan Cement, absolute nosedive coming through here. You've got an India Cements also just about at that 93 mark. Heidelberg, of course, is also down by close to about 2% odd. Are any of these stocks looking good from a trading perspective?
A stock like Deccan Cement, I think, appears to be clearly giving a breakdown below levels of 665 to about 680. That was a big support zone. I think now that the stock has broken that, good chance that we will see the stock pretest the today's low of around 600, 605. And below that, I think I'm looking at targets of around 580 or possibly 565 as well. So I think the stock will go through further correction. I think today is just the start of the correction. You will have intraday or, 1-2 day kind of pullbacks in between. But now I think 665 to 680 will be a tough level for the stock to get above. And I think on the downside, we will hit levels of 610, 580 to about 565. Similarly, an India Cement, which was doing extremely well, I think now appears to be giving a slightly bigger pullback. I think it can still, try to find support around the 90 half mark. I think if it can hold those levels, then the stock should do well, and we might even look at a long trade or a reversal from those levels. But for the timing, I think 90 could be tested over here.
Okay, just let's check in on the Nifty futures and tell you how things are shaping up on that front as well. The bank Nifty as well, and you've got a number of stocks which are seeing hefty selling and short positions being built up. GVK Power, Syntex, JSW Energy Futures, GMR, Jayaprakash Associates, Reliance Infrastructure Futures, and really the picture over there also looks awfully bleak. But I just want to point out that while the fall that you're seeing in the broader markets is far more, the stocks from the large caps or from the benchmarks are the ones that have hit their 52-week lows, be it SBI, PNB, TCS, Adani Port, Idea, ICICI Bank or Axis Bank. So none of the top 20 losers on the CNX 500 are at their 52-week lows. All of the ones that I just mentioned are from the large cap pocket. Let's get in thoughts then, Mayuresh, on this entire argument that I was having with Deepak as well. What's your view on how macros stack up for the long haul? Does the India story look good as compared to the other emerging markets? Should that give us, should that be the silver lining?
On a relative check, Aman, I think we are better placed when it comes to how our GDP estimates are panning out. Our currency has been far more resilient when you talk about the other emerging pack. However, as I mentioned earlier as well, the expectations were a little bit too high a few quarters down the line, and we are realigning ourselves to the fact that it is going to take at least a couple of quarters for earnings to revive. It's going to take that amount of time period for the credit cycle to revive. It's going to take that amount of time period for the capex cycle to revive. So clearly, I think you're talking about a phase where you're probably seeing sluggish activity happening on the corporate side. You look at the figures when it comes to the investment ratios as a percentage of GDP. You talk about the corporate investments as a percentage to GDP. I think it's still languishing at lower levels, and no meaningful pickup has probably been seen even on the private side when it comes to capex. So clearly, you're talking about a scenario where the sluggishness in corporate activity might continue for some length of time. Add to that, probably you've got the uncertainty, as I mentioned earlier, with how the crude price might behave, which puts into question mark the entire argument of how global growth and how global demand might pan out. So that will have a repercussion effect in how the earnings or how risk assets are perceived, and equity markets will take a hit in that respect. So clearly, I think one clearly needs to understand all these factors, how data points basically come through, not just on the domestic scene, but even on the international scene. And again, I think clearly the markets will react both globally and domestically on those factors. So clearly, I think, as I mentioned earlier, the softness is expected to continue in riskier assets, equities being a component and an integral part of them.
Clearly, it's the risk-off sentiment that seems to have at least taken hold of the market. We can just hope that the situation doesn't turn as dire as 2008. Nevertheless, gentlemen, thank you so much, each of you, Deepak, Mayuresh, as well as Mitesh and Dr. Narayan, for joining us for this chat on the absolute sell-off that we've seen in the markets in the last half an hour. But we'll take a quick break then. Be right back with lots more market coverage on the other side.